Hi, good afternoon, everyone that's joining us. We're going to wait about another minute to let other folks come in, and then we'll get this get the webinar started with our guest today, Professor Scott Baier. So just give us about one more minute. All right, why don't we'll get the webinar started. Good afternoon and welcome to the Foundation for Teaching Economics webinar on the current state of the American economy. Today's talk will highlight new data and trends in the US economy. I'm Ted Tucker, the Executive Director of the Foundation, and it's my pleasure to introduce our speaker today, Professor Scott Baier. Professor Baier is currently the chair in the economics department at Clemson University. In addition, he has served as a visiting scholar with the Federal Reserve Bank in Atlanta and was a senior economist with President George Bush's Council for Economic Advisor. Professor Baier's research interests focus on the understanding of causes and consequences of globalization and the economic impact of free trade agreements and economic growth. His knowledge of economic data and where to find it makes him an astute observer of the American economy. He's also been a longtime instructor in our Economics for Leaders program, and I'm grateful for him giving today's presentation. Like all webinars, a recording of this webinar along with Professor Baier's slide deck will be posted on the FTE website in about a day or two following the conclusion of his presentation. After his talk, we'll have about 10 to 15 minutes of questions. Please use the Q&A feature to submit a question, and don't hesitate to upvote questions that you see that you might like. We typically will use that feature to prioritize questions for Professor Baier. And then following the webinar, we'll just ask that you complete a short survey. So we just know how the webinar went and if you found it informative or not. So without any further ado, I'd like to turn it over to Professor Baier.
Thanks, Ted. Well, it's good to be back again. And so I'm just going to jump right in to my slides to make sure we have enough time for questions and answers. So I redid my slides today from probably the last time I did a state of the economy and the last time I did a state of the economy for FTE for sure. So on occasion, I may be caught off guard by some of the slides that show up, but I think I'll be able to adapt relatively quickly. So again, where are we? I mean, the almost obvious place in the kind of the first place we always start when we think about where the economy is we talk about income or real gross domestic product in the U.S. economy. So again, I'll start with this standard slide, and you can go back to 2000 and look at GDP over time. And what I'm highlighting here, I'm going to highlight in the next couple slides, really are the differences in the two recessions that we have had in the 2000s, one being the Great Recession. And you can see the type of recovery we had in the Great Recession. If I draw in this naive trend line, when we went into the Great Recession, rather than bouncing back like we normally do, we stayed below the trend line and then continued almost on that same pattern of growth. And economists refer to this as a L-shaped recovery because we never moved back up to the trend line. Unlike the Great Recession, coming out of the pandemic or where we at in the pandemic, however you want to refer to it, you can see that the recovery looks a lot different in the sense of this is your traditional V-shaped recovery. There was a dramatic drop and a relatively quick bounce back up. And then what you can see here at the end, there's that quick V-shaped recovery. And then what you can see at the end and what people have some concern with now is that the last 2 quarters GDP growth was actually negative. And so there's some talk or some belief that we are currently in a recession. So I'm going to talk about all of those issues, whether we are currently in a recession and where are we heading. So, before I do that, let's think about the how we define, or how economists define, a recession. Again, kind of the popular way that most people do that is they say that there are 2 consecutive quarters of negative GDP growth, and generally that is consistent with typically when we have a recession. But the official dating of a recession falls to the National Bureau of Economic Research, and they are the ones who define a recession, and their traditional definition of a recession is one where you have a significant decline in economic activity that is spread across the economy and lasts more than a few months. So again, the key thing that I think is going to be different, why many economists don't think we're currently in a recession, is the notion that it isn't spread across the economy in many, many areas. So we'll talk about that and flesh that out in a little bit more detail. But again, some of the criteria that are used to define by the NBR whether you're in a recession or not is the depth, diffusion, has it spread through all the sectors, and the duration. And oftentimes, some may be more prevalent than others, but again, what we're typically looking at are losses in income, employment across many different industries that last over a period of time. And in many ways, we haven't seen this over the last 2 quarters. So again, employment changes and changes in employment are also indicators used by the NBR. And as we'll talk about as we go through this talk this evening, that in many ways, employment and changes in employment and the unemployment rate are indications that things aren't so bad right now. And so what we're trying to do, and when we look at what's going on in the economy, is trying to assess what's going on with GDP, why we've had the negative GDP growth, and understand a little bit better what's going on with employment. So I'm going to walk through again, explain why GDP had that strong bounce back, or that V-shaped recovery, talk a little bit about that. And what I'm going to focus on as I talk about that are how some of the components on the demand side help fuel that recovery. So when we think about GDP, remember it can be divided up into expenditures on consumption, investment, the purchase of plants, machines, and equipment, government spending, and exports and imports. And again, remember the biggest component, and this is going to be one of the key things here, is that consumption is actually roughly 2/3 of GDP. So again, as we think about that, when we talk about GDP growth, remember, GDP growth is going to be a combination of growth in its components. So it's going to be a combination of growth in consumption, investment, government spending, and net exports. And it's going to be a weighted average of those components. So, and again, when we think about consumption and we look at consumption growth, we say if a consumption accounts for 2/3 of the economy, and if consumption grew, or consumer spending grew by 3%, then we would say that consumption growth accounts for about 2 percentage points of GDP growth. That is, we take that consumption is 2/3 of GDP, we multiply that by 3%, and voila, we get the consumption accounts for about 2%. So I'm going to walk through that, and a lot of the slides, I'm going to have that, not explicitly that math in there, but it's going to be implied. We're going to look at how much consumption, how much investment, how much government spending and net exports have contributed to GDP growth. Again, there's a slide I showed before, again, highlighting that V-shaped recovery with real GDP. If we switch over and look at personal consumption expenditures, we can see again that similar V-shaped pattern. And the one thing that jumps out here about this V-shaped pattern is not only have we gone back up the trend line, we've actually also gone over the trend line. And we can think about why that may occur, and I'm going to come back to that in a couple slides. Another way to depict GDP growth, or consumption growth, or its consumption's contribution to GDP growth, is through a bar chart. And what I'm going to do today in tonight's talk, I am actually going, when I depict a lot of the data today, I am going to skip the beginning of the pandemic where we had that dramatic drop in GDP and the dramatic drop in all the components and the big jump up in unemployment. And I'm going to focus on what's happened since then, because when you include those the initial couple periods of the pandemic, it really distorts almost all the other graphs. So again, this I'm just putting up here today or right now to say, look, going forward, I'm going to almost always skip some of those big dramatic drops. So again, if we look then at, if we focus on consumption growth and we compare it to GDP growth or consumption's contribution to GDP growth, what we should note initially coming out of that big drop in GDP, it really was driven by consumption. You could see that, you know, in October of 2020, GDP grew by about 4%, and consumption accounted for about 2.5% of that. So again, and then when you look at what happened in the following quarter, GDP grew by 6%, and consumption's contribution was 7%. That means the rest of the components of GDP actually knocked off of consumption. And again, you see that as well in the subsequent quarters. Now, as we move out, one of the things that becomes what you see here is consumption's contribution after this initial bounce back has been a little bit more muted. And so we're going to see now, you know, what do we think is going to happen in the future? And why was the consumption response so strong? Well, if you've seen some of my talks before, one of the reasons why we see that consumption response being so strong is we can look at what was happening with personal income and personal expenditures, at least initially. Typically during a recession, personal income drops dramatically. But again, if you draw on this sort of naive trend line here of personal income, you could see during the pandemic, personal income actually spiked up. Well, what was going on here? Of course, these were the transfer payments and other aspects of the stimulus that injected money, got income into people's hands so that they had additional income. And so you could see during the pandemic, when people pulled back, stopped going out to eat, stopped going to restaurants, stopped consuming a lot of consumer services, there was a relatively big drop in consumption, but then again, a kind of V-shaped recovery as expenditures then increased, and now expenditures are above trend. And I think one of the things that we've noticed is consumption still helps to push forward GDP growth, even after these transfer payments have ended. Well, why is that? Well, when people received these transfer payments or had this additional income, they saved up a lot of it. And the next slide, I think, highlights this aspect. Is what you can see here is income goes up above trend, consumption falls below trend. So that sort of difference, what I calculate here, is excess savings. So even when transfer payments went away, households across the US had a nice nest egg of excess savings that they can draw on and still draw on as they consume. And so this graph highlights this, that beginning at the beginning of the pandemic, consumption dropped quite a bit. People received transfer payments and income went up. They didn't spend all of that. So they, at one point in time, consumers had roughly $2 million or $2 trillion in savings. And then since those transfer payments and other forms of the stimulus package have ended, though that excess savings has been bid down as consumers consume out of that, again, to help push consumption along. So again, you can draw this many different ways. In general, you're going to have this same slope. I wouldn't bet on this was the exact right amount, but the general slope is going to look the same. And the key takeaway from this is that during the pandemic, people saved a lot. That excess saving is helping to drive consumption forward even post-pandemic. But again, we see that being bid down a little bit. Another key aspect of the pandemic was this twist that we see in terms of people consuming more goods and fewer services. Again, intuitively, that made sense, right? You couldn't go to movies, couldn't go to shows, couldn't go out to eat. And so you would try to bring those goods home by buying home entertainment systems, more electronics. And so people's consumption shifted toward goods. A clearer way of seeing this, again, this is in levels. What I did here on the next slide is at the start of the pandemic, I normalized everything here to being 100. So how you view this is any deviation away from that initial start of the pandemic is the percent change in consumption of goods or services. So again, that we normalize the start of the pandemic to 100. And one of the things, oops, I want to go back to this slide first. One of the things we see is people tilted their consumption. You saw that spending on goods went up by about 21%. And so people were buying, again, things to make life at home more comfortable. And then spending on services dropped for a relatively long period. And it took quite a long time period to get back up to kind of where they were before. Still really almost not on trend. The one thing I think that people are surprised by to this date is that we thought consumption patterns would have normalized a little bit more, in the sense of people are going back out, kind of living more normal lives, and they're like almost back to pre-pandemic, yet spending on goods still remains about 14.5% higher than what it was pre-pandemic, and spending on services has just barely got back to that point. So I'll come back to talking about what that spending on goods and services means for other aspects of the economy. But again, that's one of the key features that we see now. And one of the surprising things that we have witnessed is we haven't seen consumption patterns renormalizing back to where they were before, where goods consumption falls and service consumption rises back up. If you look at investment spending, again, initially coming out of the pandemic, we got a little boost here in terms of investment spending. It went back up, but again, throughout, investment spending has either been negative or very small contributions to promoting GDP growth, with the exception of one quarter here, and that was in the fourth quarter of 2021. And if we think about investment in general, you would understand probably if you run a business or run a firm, there was a great deal of uncertainty surrounding almost anything that you did or anything that you would do in your business. So you were going to be less likely to buy plants, machines, and equipment. And so again, that's kept investment spending muted. That big jump up that we see here in the fourth quarter of 2021, that really was driven mostly by inventory, changes in business inventory. And that's one of the reasons, and I'll come back to that, this big boost we had from changes in business inventory, that's one of the most volatile components of investment spending, of GDP accounting. So once we see a high number like that, we know in subsequent quarters it's likely to revert. So what happened in the fourth quarter? We saw this big boost to GDP from business inventories, but we had a dramatic drop in inventories in the first quarter. And that was one of the reasons why first quarter GDP was negative. It was because of reversion back to more normal inventories. And then we had a further reversion in inventories in the second quarter. So that's one of the reasons why we've had two negative growths. One, because we had this big buildup in inventories, and it's been bid down the last couple quarters. Another thing that's going to put a pause on investment in terms of contributing to GDP growth. Of course, residential investment or the building of new homes counts as part of of investment. And one of the things that we've seen over the last few months, and I'm sure all of us are aware of, are rising mortgage rates, right? We've seen these increases in mortgage rates are driven by higher inflation expectations, as well as increases in the interest rate by the Federal Reserve. Those things are pushing up interest rates and again, slowing down housing starts. And you could see that impact here as housing starts slow down. That's going to be a drag on residential investment in general, and a drag on GDP. So again, when we're looking what's going to be pushing GDP forward in the coming months, I wouldn't be looking toward investment still because of the uncertainty still, I think, that surrounds where we are in the economy, as well as the higher mortgage slowing down one of the components of GDP. When you look at government spending, it really is not much to look at. And maybe this is a surprise to some people that government spending hasn't contributed a lot to GDP growth. But remember, most of the forms of the stimulus package weren't actually government actually going out and spend. It was transfer payments that were going to different groups of individuals, whether it be in the form of PPP, whether it be form of checks that got directly deposited into people's accounts. So there was not a lot of action here in terms of government spending boosting GDP growth, with the exception of a little bit there. In terms of net exports, again, haven't contributed much to GDP growth. Again, one of the explanations of why, though we had negative GDP growth in the first quarter of 2021, has to do with imports. And remember, imports don't count negatively against GDP, that it is an offset. Remember, imports don't count as nothing in terms of adding to GDP. But what we have to think about is when I buy, say, if I buy an imported car, that car shows up as a positive in terms of consumption and in terms of GDP. So it shows up as a positive, but it wasn't produced in the US. So we subtract it off in terms of imports. So net, that purchase of a car has no impact on overall GDP. What happened here in the fourth quarter, though, is the timing of when imports come through the ports can matter to GDP in a quarter or two. And what happened in that first quarter of 2021, we processed a lot of goods through our ports. Again, remember all the container ships we had sitting out there. So this faster processing of imports led to a bigger drop in net exports, and that was also the drag on GDP in the first quarter. So again, one of the points I'm making here in the outset, there were a lot of special factors at the beginning of the year that led to that first quarter of GDP growth being negative, that really had less to do with actual slowing of income, but more to do with the pandemic and kind of some strange timing of how things pass through. So some quick takeaways of GDP growth and its components. GDP growth has been supported by relatively strong consumption. And again, consumption remains tilted toward goods rather than services. And consumers continue to spend, but they're spending through that excess savings that accumulated during the pandemic. And how much longer that carries them, or how much they want to burn through that savings, again, will help determine what future GDP growth is going to look like. Investment spending. Again, I don't think that investment spending or the purchase of plants, machines, and equipment in residential housing is likely to contribute a lot to GDP. Higher mortgage rates will likely slow residential investment, and fixed investment plans remain uncertain just because of the overall state of the economy. So again, consumption looks like it's going to be the main driver. And again, net exports, we can think that now that imports have kind of normalized, we hope that net exports will lead to a boost in GDP, but exports will depend likely on how world GDP growth occurs. If the rest of the world is growing relatively fast, they typically buy more of all goods, including goods that are produced in the US. So if we have robust growth around the world, that will help lift GDP growth through exports. But if GDP growth slows around the world, that's likely to reduce our exports and slow down overall GDP growth. So again, going quickly, why we saw those two negative quarters, and just not to necessarily explain them away. GDP was a little bit lackluster, but there were some special things going on in the first and second quarter of this year. The first quarter, of course, we almost forget now, we had the Omicron variant that had some small impacts on January and February and slowed down GDP growth. As I mentioned, those changes in business inventories are one of the least persistent parts of GDP growth. So in the fourth quarter of 2021, they added a lot to GDP growth. We would expect those effects to be smaller, if not negative, in subsequent quarters. And that's exactly what we saw in the first quarter of 2022 and the second quarter of 22. It fell from 5% to 1% and then actually went negative. So both of those effects helped slow down, in some sense, GDP growth. Then also the issue of net exports. Remember, net exports, as I mentioned, we processed more imports through our ports. Just that simple timing of that quicker processing slowed down GDP growth because we counted more imports, and so that knocked off 3% in the first quarter. So again, that's why we had those negative quarters. If I'm looking forward now, what is the data telling us? The Atlanta Fed's GDP now predicts that the growth in the third quarter of this year will be roughly 3.1%. So that looks pretty good. Where's that growth coming from? It's really being driven by two factors. Consumption spending looks like it's going to add another 1%. So again, consumers continue to go out and spend. And there seems to be some positive effect from net exports, strong demand for our exports. And again, the imports aren't subtracting off as much. Investment spending is actually is knocking off of GDP growth, and that's mostly being driven by the decline in residential investment. Again, if we think that the higher mortgage rates are being driven by the Fed pushing up interest rates, and that leading to a decline in residential investment, and that's the Fed's goal, is to kind of tampen down demand a little bit. Maybe this decline in residential investment is an indication that the Fed's policies are beginning to work in terms of slowing down different components of demand. Government spending looks like it's going to add about a little bit over a 0.5 percentage point to GDP growth. So again, this next quarter, this third quarter, things look pretty good, likely to get a positive read on GDP growth. But going forward, I think things look a little bit less certain. One of the things that's going to be very important is it depends on how difficult it is for the Fed to bring inflation down. If inflation remains sticky, if inflation remains elevated, they may have to take a more aggressive attack on trying to bring down aggregate demand by slowing down consumer spending and investment. And again, we think that could lead to lower GDP growth and even push the economy into a recession. Also, in terms of consumption, some news that came out just the other day that consumer sentiment seemed to be weakening again a little bit. And usually when we see consumer sentiment weakening, that also we see consumer spending less. It coincides with that. Another issue that I think is going to be important that's more difficult to read are what happens on the supply side factors. Most of the talk, and it's easy to talk in economics about what's going on the demand side because it's pretty easy to read tea leaves. But on the supply side, what drives the supply side and what drives productivity growth and innovation, we typically, as economists with our 30,000-foot view or our 50,000-foot view, we don't know where the next innovation is going to come from. We don't know where productivity growth is going to come from. And usually some innovations and some productivity growth are like throwing the quintessential rock into the pond where it have ripple effects across the economy. We don't know when that rock is going to be thrown, when that rock is going to hit, and how big those ripples are. And so again, it's hard to assess on the supply side what is going to be the next leader. So in the long run, remember, economic growth is driven by productivity growth, but it's difficult to project where and when that productivity growth is going to come from and how it's going to impact other sectors of the economy. The best thing that we can do is have in place is economic policies that foster productivity growth and foster innovation, and then let aspects of the market take care of that itself. So moving away from income and GDP and switching over to employment factors, I'm going to spend a second on the side. As we can see that unemployment now has dropped down to 3.5%. We had that big spike in employment at the beginning of the pandemic where inflation jumped up over 14%. And then we kind of came down quite rapidly. And if you compare it to other recessions or other hills that we've come down from, notice the rapid descent, which again is consistent with a V-shaped recovery of how quickly the economy came back after the, on the other side of the pandemic, again, if we want to consider ourselves on the other side of the pandemic. And rather than looking at unemployment, I think it's useful to look at levels of employment. And so here I've graphed levels of employment. And if I draw back to the start of the pandemic, from where we are now, you can see that we've roughly got back to where we were before. So again, employment has kind of recovered to the pandemic. But again, if you think about where we should be or where we would hope we should be, you could again draw in this naive trend line and say, if we would have continued along the trend and not fallen into the pandemic, how many more jobs would we have? And if I look at this gap, and I measured this gap this morning, again, this naive approach says we're about 5 million jobs less today than what we would have had if we didn't have the pandemic and if we would have continued along this kind of steady growth as before. There's no guarantee that we were going to do it, but it gives us some idea of where we are versus where we could be. Again, the one bright side is that in a relatively short period of time, we've caught back up to where we were. And again, this shows the recovery looking at the changes in employment from month to month. You can see in May in 2005, we added about 2.6 million jobs. In June, we added 4.5 million. And then in almost every month except December of 2020, we've added a positive number of jobs. And in fact, some of these job additions or job changes in employment have been quite large, over 700,000 here, almost 700,000 there. But one thing you kind of see at the end here, what we're seeing is while we're still adding a fair amount of jobs, the kind of overall average seems to look like it's going down. So we might be getting closer to this tail end of how quickly we're adding jobs back to the economy. I sure hope we're not. But again, just looking at a simple average here over the last 6 to 8 months, it certainly looks a little bit smaller than what was occurring prior to that. And again, it's always nice to, well, I think it's not nice, but it's useful to compare employments across industries and how it's changed coming off of the pandemic and to where we're at now. So what these bars show, and I'm going to keep these in red, these highlight the job losses that occurred in March and April, March and April. I don't know why it says February and May, but what we have done here is we've lost you look at leisure and hospitality, again, to give an example, we've lost 8.2 million jobs in leisure and hospitality, almost 3 million in education and health. It was really mostly health, and over 2 million in business services and over 2 million in retail trade. And so thinking about those job losses, the next slide is going to show, and it's going to be in blue, it's going to stack right next to it, the job gains that had occurred from May of 2020 up until the most recent jobs report. And what you can see here, in some ways it's surprising to me when I put these slides together again just the other day, is that in almost every industry, construction, manufacturing, wholesale, retail trade, transportation, information systems, financial activities, you get the idea that we currently have more jobs now in those, more employment in those industries than we did at the than the jobs that we lost. The big exceptions are here in leisure and hospitality services. We're still about 1.2 million jobs below where we were. Also a little bit lower in other services, and mining and logging is a little bit less, almost, but that number is almost inconsequential compared to these others. So a lot of industries have rebounded quite well. That leisure and hospitality industry and some of the other service sectors still haven't got back to where we were before. And then again, you could see, you know, what is kind of slowing things down, or one of the things that we see all around us to this date is this mismatch between what firms are trying to hire, job openings. At one point, we had almost 12 million job openings in the US, and hiring hasn't responded. So again, the way I like to read this chart, if you kind of look at this, these things move almost in lockstep. And this is the entire history of job openings and job hires that we started to record this data. We just started to record these data back in 2000, and you could see they track relatively well with each other. But again, then coming out of the on the other side of the big drop in caused by the pandemic, we've seen this big jump up in job openings and not a big jump up in job hires. And again, we're starting to see some of these job openings be filled, but again, we still have a relatively long way to go. So this is a data picture, I think, that captures a lot of what we see when we drive down the roads or go through city streets or other parts of town. That seems like every firm has some type of job posting in their window or advertising someplace online or other places. Another comment that I think people often bring up about employment is they make an argument that, well, a lot of the employment losses that we're seeing are people retiring, and surprisingly, that's not the case. If you look at the change from start of the pandemic to where we are now, of workers age 65 and up, you actually have more workers age 65 and up working. Age 55 to 65, you have a few fewer. Quite a few people between the ages of 35 and 45. A big change, over a million workers, individuals between ages 35 and 45. The big drop, and kind of the surprising thing, and I think it's a concern for economists and lots of politicians and social commentators, is the number of people between the ages of 20 and 34. The number of job losses, over 1.2 million, almost 1.25 million of these people. Fewer workers between the ages of 20 and 34 are 1.25 million fewer workers between that age group. Why does that age group feel disconnected from the labor market, or why haven't they gone back, is a question that we really don't have an answer to. We saw something similar coming out of the Great Recession for males between the ages of 20 and 34. But when we look at the data now, it seems to be similar for males and females, that they're less willing or least likely to go back into the market. One aspect I think that's interesting also, if you look at wage growth by different industries, those people who had some concern for income inequality, what you're seeing here is some kind of not normalization, but kind of a boost to lower wage workers. But when we think of leisure and hospitality industry, we usually think of those being more dominated by lower pay. And we've seen that they've had the biggest increases in hourly earnings. Again, maybe that's not too much of a surprise. As you drive by the streets, you see a lot of ads for, take a job here, we're paying $15 an hour, come here, apply, we're offering this signing bonus. But in a lot of industries where you see a little bit lower, typically lower wages, they're the industries that are growing, that have the fastest growing. And in fact, the leisure and hospitality industry is the only industry whose wages were growing faster than the inflation rate. And you could also do this by income category. And you can see that over this time period that the lowest quartile wage earners had the fastest real wage growth. So it was actually positive for the lowest quartile. And it was the lowest for the highest quartile. So again, for those individuals who are worried about income inequality, the pandemic has seemed to kind of help narrow that gap. Certainly hasn't narrowed it a lot, but it has narrowed it some and kind of tilted the scales for lower income individuals, lower wage jobs. So taking a look at the overall employment situation, the economy continues to add jobs, but not quite at the same rate as before. The challenge is that still remains for employers to fill vacancies. And we don't have an answer to this question yet. Coming on the other side of the pandemic, one of the questions, one of the things that people said, well, why people weren't going back to work was because of the extended unemployment benefits and other stimulus payments. Well, those have ended now, and we don't see people going back to work. Maybe they're sitting on their savings and being a little bit more selective. But if those are the things that were driving people from taking a job, we probably would have seen more people going back to work. One of the things that certainly is likely to be the case, and we don't know the extent, we haven't measured the extent of what that's true yet, is certain workers are reluctant to go back and work in certain industries and occupations. Maybe they feel it's less healthy. Maybe they want to have a job that provides them more satisfaction, but they're less likely to go work in certain industries and occupations, and that may be the trade. When you talk to some workers and you survey some workers seem to be looking for different career opportunities. And one of the things that we also see is a lot of workers aren't switching industries, but they're staying within the same industries and they're moving from one employer to the other. And when you ask them why you moved, sometimes it's about wages, but not always. Some of the time they're looking for non-pecuniary benefits, like the increased desire to have options to work from home, better working conditions, better recognition of your accomplishments and things of that nature. So again, as potential employers out there, again, not only should you have to, I think employers have to worry about offering higher wages to attract workers, but working conditions and job satisfaction are important to workers. And I don't think that should be a surprise to many people. Switching over to inflation is going to be kind of the last topic, and we'll wrap things up. When we look at inflation, what we see is two things. One, overall headline inflation, jumped up, reached its highest point. If I mimic the news, the news headline, it's the highest level since the 1980s, or the highest level 40 years ago. But again, what makes it different than 40 years ago? Heck, we were happy 40 years ago because inflation was beginning to come down. Back when inflation started to jump up, we didn't know where it was heading. We see it coming down a little bit. It's a little bit early to say that it's coming down for good. One of the concerns I think that is driving the Fed now, and we'll talk more about Fed, is when you look at inflation, where you strip out the more volatile components of food and energy, that's starting to rise. So what we're seeing is inflation is bleeding over into other aspects outside of food and energy. And again, the Fed is concerned with how you're going to bring back not only headline, but also inflation, less food and energy. I'll skip that slide, for time's sake. If you look at, again, this highlights kind of like the last thing I said, that what we're seeing now, initially when inflation jumped up, we thought it was going to be mostly driven by food, energy, and some other supply side shocks or supply chain shocks. What we're seeing now, again, it's now filtering over into housing or shelter, into commodities and other type of services. And those things have a tendency to be more sticky and more difficult to bring down. And so I think that's why the Fed is being a little bit more aggressive with their policies going forward. And this leads me to supply chains. And one of the things that we see with supply chains, the New York Fed has created a data series that look at supply chain pressures. And if you look at the supply chain pressures now, they look like they are starting to ease. And they're not back to pre-pandemic levels, but it's a lot easier. That the time it takes to ship a good from one place to another has gone down. The amount of time it takes to pass through the ports have gone down. All those things are easing some of the supply chain pressures, and maybe will have a dampening effect on inflation. One of the things you could say is that we think that the supply chain pressures may be easing because demand is falling. But when you talk to individuals who run plants and run businesses, they say demand remains high. And again, we know demand remains high, especially the demands for goods. If we go back to that slide I showed before, where we have that demand for goods and services, again, being about 14.5% above where we were pre-pandemic. So again, we know demand still seems to be robust for goods, for manufacturing goods. And so that gives us an indication that really it is the supply side that's starting to ease, that we're starting to get more normalization of supply chains. And again, when I talk to firms out there, when they talk about how they're managing things, they went from just-in-time management to just-in-case management, inventory management. So we see firms, if they're adding anything in terms of investment, if they're adding storage capacity and providing and adding a little bit more inventories, and again, other connections in case there are supply chain disruptions. When you look at another thing that I think it's important to look at, again, this, which is related to this big spike up, I should say, the spike up in the demand for goods and the drop in the demand for services. If you look at price increases year over year, this big increase in the demand for goods is one of the main drivers of inflation. It was difficult to ramp up production. We didn't have spare capacity. It was hard to find workers. So part of an increase in the demand for goods, home entertainment systems, other things, was part of that demand was going to manifest itself in higher prices. And so what we see is inflation in goods. I don't like to necessarily use that term, but we had a jump up in inflation in goods, and it's currently at 8.6%. If you go back pre-pandemic, things like robotics, technology, and globalization were keeping goods inflation relatively low, quite close to zero. But it was this the pandemic that switched people's consumption of goods, and we couldn't ramp up production. We had a spike up in inflation in goods. And now what we're seeing, inflation in services was relatively low, but over the last, say, 16 months, we've seen inflation in services going up again as well. And that's another thing that concerns the Fed. So a question that often comes up, and I'll try to wrap things up in the next like 2 minutes here, is inflation a global phenomenon? And the answer to that is yes, but the sources are what I'm going to argue here are different. In terms of basic supply and demand, we can think through the sources of what's causing higher prices. If prices are increasing and they're driven by supply, what we're likely to see are higher prices and lower quantities. That is, they're negative supply shocks. And what we should see then, if it's supply shocks that are leading to inflation, we should see real GDP below trend. If the price increases are demand driven, what we're likely to see are higher prices and higher quantities. That is, positive demand shocks. We're going to see higher nominal GDP as well as higher real GDP. So again, what we're going to do is look at real GDP and nominal GDP. If real GDP is at or above trend, demand shocks are likely to be more important. If nominal and real GDP shocks are above trend, if both of those are above trend, it's likely to be the case that demand shocks are also going to be the main driver. So if I look at US real GDP and I draw in that naive kind of trend line, what we see here is that US GDP really bounced back up the trend. And so what we're looking at here is something that looks more like a demand shock, whereas you look at EU real GDP, and that looks like they've been hit with supply shocks, mostly dealing with energy and other things related to the Ukrainian conflict. So kind of drawing contrast between the US situation and the EU situation is the EU certainly looks more like they're being hit by supply shocks than the US. And when you look at nominal GDP in the US, you can see in terms of nominal GDP, the US is well above trend. And when you look at nominal GDP in the EU, they look like they're about at trend. So if you kind of put those two things together, yes, inflation in the two areas are relatively high, but the nature and the causes of those inflations are a little bit different, or quite a bit different. US looks like it's demand driven. EU looks like it's supply driven. Why is that important? If the shocks are demand driven, it means that the government response by the stimulus and other things during the pandemic are at least partially responsible. That's not the big thing. The bigger thing is if the inflation is mostly demand driven, that means the central bank is better equipped to respond to higher demand than supply side shocks. See how the Fed acts is by raising interest rates, pulling down demand for investment and consumption, so they can pull back that demand. When it's a supply side shock and you pull back demand, that's likely to make things worse in terms of real GDP. So I think in terms of navigating its way through this in higher inflation, the US central bank is in a better position. And again, for lack of time, I'll quickly say where I think the Fed is going. Well, I would suspect next week that the Fed will continue to increase the federal funds rate. Again, it really wants to bring that inflation down. The main concern the Fed has right now is that inflation has bled over out into other aspects, shelter, commodities, services. Those things are stickier, and once they start going up, they're harder to bring down. So what I would anticipate is the Fed in November is going to increase the target federal funds rate by 75 basis points. And then once again in December, they're likely, I would say more likely to do 75 basis points again in December. I think at that point, once you get to January, they may take a pause, get a reading on what real GDP is and other components of the economy, and then go from there. But again, what I would anticipate is the Fed to be relatively aggressive in terms of trying to bring down inflation, given that it's high. So I'll stop at this point and I'll take any questions that people have.
Great. Thanks, Scott. We have a fair amount of questions here, so we'll try to work through as many as we can in our short time that we have left. We have a question here from Jennifer. It's kind of a multi-part question, but it comes down to, she's asking, how accurate is the unemployment data in capturing the full picture of the labor force?
Yeah, I don't look so much at the unemployment rate. I always put that slide up and I talk about that, but it's a complicated, it can be complicated. The number I think is better to look at is the employment number. That tells us how many people we think have jobs, and then you break it down by industry and you can see what industries are lagging behind, and then you can compare that with production. I think that gives you a more accurate depiction of what's going on in the labor market. So I prefer to look at employment and employment by industry. And then again, as I showed earlier, what's going on in terms of hiring and layoffs. I think those are better representations of the labor market.
We have a question here from Mike, and Mike is saying, I have recently seen comments to the extent that the Federal Reserve is too aggressive in their actions. If left to itself, inflation will be healing itself without the pain of increased unemployment that interest rates hikes might bring. What are your thoughts on this train of thought?
Yeah, so Greg Mankiw just had a short piece today where he believes that the Fed is being too aggressive. My concern remains that I think once inflation gets into these other sectors, as I mentioned, services and housing, it remains it becomes a little bit more sticky and harder to bring down. Another slide that I kind of skipped through is that there still remains quite a bit of liquidity that households have in their bank accounts. Unlike during the Great Recession, when the Fed increased the money supply, the banks just held on to it. With this episode, the money went right into people's checking accounts. And again, if you think in any sense that Friedman might be right, if people have money in their accounts, they're likely to rebalance their spending in some ways or rebalance their savings, and eventually that money is going to be spent and lead to higher prices. So I would support the Fed increasing the federal funds rate in the next 2 months and then taking a pause. But I am sympathetic to the concern that they may be doing too much.
This is a question from Eric. Eric's asking, what are some of the commodities that you've been referring to?
Well, I think, so initially we saw the rise in oil prices, and then we saw an increase in some of the prices in grains. And part of those were impacted by the Russia-Ukrainian war. They've normalized a little bit, but there is a concern of what's going to happen with oil prices once the federal government stops using releasing oil from the strategic petroleum reserves. And again, we're always subject to other things occurring with the commodity prices, especially wheat. I think is one that we seem to be in short supply of currently.
Now, here's a question from Mike. He's asking, how would you compare our economic situation with that of the United Kingdom? Should the two countries take the same course of action to fix their economic issues, or take different or separate paths?
Yeah, I
Testing your expertise on UK.
Yeah, I think the UK is in a little bit different situation than we are, than what the US is, and I'm not sure what the best path for the US. One thing I didn't mention that I think is a big concern about going forward is the political uncertainty and what the election is going to bring, and what economic policies whoever controls the House or the Senate are going to bring. It's not clear that to me, at least immediately obvious to me, that another round of tax cuts or another round of just spending are going to resolve our problems in terms of employment and inflation. I think we need to be a little bit more judicious and targeted with how we spend and tax.
And then here's a question. Carol's asking, actually, this is a good question here. She says, what is a basis point?
Oh, a basis point. So if interest, yeah, I should have been clear on that. So if I say mortgage rates goes up by 1 percentage point, that means that's equal to 100 basis points. So again, if interest rates go up by 0.5%, that's 50 basis points. So we just break down percentages that way. That's a good question. I should have been clear on that. I apologize.
And Barbara is asking a question that I also have the same question here. Would it be a good time to buy a used or new car? Would prices be coming down to compensate for the higher interest rates on auto loans?
Well, I think that's that is what's going to happen is as interest rates go up, it typically decreases demand for those type of products. So you're going to see a likely to see a fall in the price of some cars, and you're going to see a drop in housing prices. So if you're sitting on cash, lots of cash, it might be a good time to go out and buy a new house or a new car. But going back to the car industry, I'm not sure the auto market again is back to where it's getting close to where it was. If you go, when I talk to dealers, they're starting to get new cars in with some regularity, but not like it was pre-pandemic. And one of the things I've noticed is a lot of the when you fly into an airport, a lot of the car rental places sold off their entire fleets because the price of rental cars got so high, it was profitable just to liquidate that stock. And so I'm not certain. I'd be much more inclined to buy a house than a car right now if I was sitting on a pile of cash.
So here's a question here. This will be the last question for the evening. I know we do have a lot of questions, but probably need to wrap it up, Scott, so you can actually go home. It's got to be past 7 o'clock your time, or maybe 8 o'clock.
8 o'clock.
Yeah. There's a question from Landra. And the question is, do you think employees changing roles within their current industry has a positive effect on the industry's productivity?
So, well, so that's what I think. It can have a positive effect. So I think anytime, once we go into a recession, I think what we typically have is some pruning in any industry of some people losing their job, and then people moving into positions that they're likely to be more productive in. So one of the things I think that that we do see is potential increase in productivity from better matches between workers and job occupations and workers and firms. So that's one of the things I think we typically have coming out of the recession, and why you have a productivity boost. Yeah, and Eric, and we ask Eric a question at the end here. Yeah, one of the reasons why prices of cars increased was because of computer chips, and that was driven by the demand. The demand for households to buy home electronics kind of soaked up all of those computer chips. But so that drove up the price of new cars, made new cars unavailable. So then people switched their demand over to used cars. And that's why a lot of the rental car companies liquidated their used car stock.
All right, great. Well, thank you very much, Professor Baier, for giving us your time tonight. And I want to thank all the participants for spending a time with FTE today or this evening. I really appreciate it. And we do ask that you take a couple minutes to fill out the survey at the link my colleagues posted. And we hope you all have a good evening and return for our next webinar, which we'll have in February.
And I want to thank everyone for taking time out of their evening, maybe postponing dinner or postponing something else they were going to do to join us. I appreciate all the work that FTE does to increase kind of the dissemination of economic knowledge. And I hope I did disseminate some today. So I thank you, Ted, and I thank everybody for joining us in here this evening.
And one last quick note, this presentation has been recorded, and the PowerPoint slides will also be posted on the FTE website, and as I said, in a day or two. So thank you again, everyone, and have a great evening.